The charts are screaming. The biggest banks on Wall Street are trapped hundreds of millions of ounces short, and they're about to face a decision that could bankrupt them. Next Monday morning, when Asian markets open, a mathematical event is scheduled to begin. Not a prediction, not a theory, a structural inevitability. The vaults are empty, the algorithms have flipped, and the industrial giants are bidding directly at the mine sites, bypassing the entire system. What happened in 1980 with the Hunt brothers, it's about to happen again. But this time it's not 2 men, it's millions. And the banks cannot stop what's coming. Welcome to Boring Economy, where we make the complex. Welcome to Boring Economy simple and the invisible visible. Now, if you've been in the markets long enough to remember when a handshake meant something, when research was done with newspapers, not algorithms, then you know the value of real analysis. Do me a favor. The same way you'd bookmark an important document, hit that subscribe button below, because what we're about to walk through today isn't speculation, it's documentation. And before we begin, drop a comment. Tell me where you're watching from. New York, London, Mumbai, Singapore. I want to. Part 1. Technical setup and market structure know who's paying attention while the world is still asleep. Now, let's examine why $150 isn't just possible. It's probable. The silver market stands at a crossroads that traders will remember for decades. Right now, at this exact moment, the price hovers near $90 per ounce. But something is happening beneath the surface. Something the casual observer cannot see. Something the professionals are watching with growing concern. For 5 years, analysts have been tracking a pattern. A formation on the monthly chart that appears once in a generation. They call it a cup and handle. In technical analysis, this pattern is considered the most bullish signal a trader can witness. The cup forms slowly over years as the price builds a base. Then comes the handle, a final consolidation, a moment of calm before the explosion. Last week, that pattern completed. The breakout occurred during Asian trading hours when most of the Western world was asleep. The algorithms noticed first. These are not human traders. They are mathematical systems designed to detect patterns and execute orders in milliseconds, and they have switched from sell to strong buy. The shift happened across multiple markets simultaneously. Tokyo, Hong Kong, Singapore, all showing the same signal. The institutions that program these systems understand what this means. When a 5-year pattern breaks to the upside with volume, the move that follows is rarely small. History shows that cup and handle breakouts often result in price movements equal to the depth of the cup itself. In this case, that depth measure is $70. Add that to the breakout point, and the mathematics points to $150 per ounce. This is not guesswork. This is pattern recognition based on decades of market behavior. But technical patterns alone do not move markets. They need fuel. And the fuel in this case is measured in billions of dollars. The major bullion banks, institutions like JP Morgan, Krupp, and HSBC, are caught on the wrong side of the trade. They are short. This means they bet that silver would go down. They sold contracts promising to deliver metal they did not own at prices that are now far below the current market. Industry sources estimate these banks are short hundreds of millions of ounces. At $90 per ounce, their losses are already catastrophic. At $150, the losses become existential. These are not small hedge funds that can simply declare bankruptcy and disappear. These are systemically important financial institutions too big to fail, as the phrase goes. So, they face a choice. They can add more money to their losing positions, hoping the price falls back down, or they can buy back the silver, covering their shorts and accepting the loss. The problem is, buying back hundreds of millions of ounces creates its own demand shock. When the biggest banks in the world rush to buy the same asset at the same time, the price does not rise gradually. It gaps, it jumps. It leaves traders stunned as the numbers on the screen leap upward in seconds. This is called a short squeeze, and the conditions for one are now in place. The banks know this. The algorithms know this. The question is, does the public know this? The professionals who monitor the commitment of traders' reports have seen the data. Commercial traders, the category that includes these banks, are holding record short positions. At the same time, managed money, the hedge funds, and algorithmic traders are flipping long. This divergence creates tension, and markets release tension violently. There's another factor at play. The level of $95 per ounce represents the final technical resistance. Once silver breaks through that ceiling with volume, there are no sellers above. The market enters what traders call price discovery. This is blue sky territory. No one knows where it stops because there are no reference points. The last time silver traded above $100 adjusted for inflation was 1980. That was 45 years ago. An entire generation of traders has never seen triple-digit silver. When psychological barriers break, human behavior changes. At $90, silver is still seen as an industrial metal. At $150, it becomes a monetary asset. Institutions that ignored it suddenly pay attention. Pension funds that never allocated suddenly allocate. And that capital looking for a home finds a market with limited supply. The technical setup is complete. The short positions are documented. The algorithms have shifted. Now the market waits for the catalyst. And that catalyst is not technical, it is physical. There is a phone call that nobody is making anymore. In the back offices of Swiss refineries, the phones used to ring constantly. Jewelers calling to sell old silver, estate managers liquidating silverware collections, pawn shops moving inventory. This was the secondary market, the recycling stream, the safety valve that kept silver prices stable for decades. That phone has gone silent. The refiners noticed it first, sometime around December. Then the American recyclers confirmed the same pattern. People are not selling, they're holding. Part 2. Physical supply crisis and industrial demand. And in some cases, they are buying more. This behavioral shift represents something deeper than market sentiment. It represents a loss of confidence in the alternative. When someone refuses to exchange silver for dollars, they are making a statement. They are saying, I trust this metal more than I trust that paper. Historically, this shift only happens during periods of monetary stress. The 1970s saw it, the 2008 financial crisis saw it, and now 2025 is seeing it again. But this time, there's a second factor compounding the problem. Industrial demand is not just growing, it is accelerating beyond anyone's projections. The solar panel industry is facing a crisis of its own making. Every photovoltaic cell requires silver paste to conduct electricity. There is no substitute that works at scale. Copper does not have the conductivity, aluminum does not have the durability, only silver works. And the governments of the world have mandated a green energy transition, which means they have mandated silver consumption. Tesla is not waiting for the market to deliver, they are sending representatives directly to mining operations. Samsung is doing the same. The Chinese solar manufacturers are doing the same. They are bypassing the COMEX exchange entirely, going straight to the source. This is unprecedented. When the end users of a commodity start competing at the mine level, it signals that the traditional distribution system is breaking down. The exchange was supposed to be the central marketplace, the place where supply meets demand, where price discovery happens efficiently. But if the big players no longer trust the exchange to deliver physical metal, they create their own supply chains. And that removes liquidity from the public market, which makes the price more volatile, which makes the short squeeze more violent. The numbers tell the story clearly. The Silver Institute publishes annual supply and demand reports. For the past 3 years, demand has exceeded supply. The deficit in 2024 was estimated at 200 million ounces. That gap was filled by drawing down above-ground inventories, the COMEX warehouses, the LBMA vaults in London, the silver backing the SLV Exchange Traded Fund. But those inventories are not infinite, and they are dropping faster than the public realizes. Here is where the mathematics becomes dangerous. February is a delivery month for silver futures contracts. That means traders who bought contracts in previous months now have a decision. They can settle in cash, taking the dollar equivalent and walking away, or they can stand for delivery, demanding the actual metal. Normally, 95% of contracts settle in cash. That is how the paper market functions. But this month, the percentage standing for delivery has spiked. Industry insiders report that commercial users, the manufacturers who actually need silver for production, are demanding physical settlement. They do not want cash, they want metal, and the exchange does not have enough in the vaults to satisfy everyone. This creates a nightmare scenario for the clearinghouses. If they cannot deliver, they face 2 options: default on the contracts, which destroys the credibility of the entire futures market, or offer a cash premium, paying significantly above the spot price to convince traders to accept dollars instead of metal. History shows that when exchanges face delivery pressure, they choose the cash premium. In the palladium market in 2000, the exchange paid double the spot price to settle contracts. It worked. Traders took the money. But once the exchange officially recognizes a higher price, that becomes the new floor. The street price adjusts immediately. If the COMEX announces it will pay $120 per ounce to settle contracts, the retail market reprices to $120 instantly. And from there, momentum takes over because now the official market has validated what the physical market already knew. Silver is worth more than the paper price suggests. The scrap is not coming. The industrial demand is surging. The inventories are draining and the delivery requests are piling up. This is not a technical problem. This is a physical reality, and physical reality eventually always wins. There's a number that central bankers check every morning before they drink their coffee: DXY, the US dollar index. It measures the dollar's strength against a basket of foreign currencies. For decades, this number stayed within a comfortable range between 90 and 105. Central bankers could manage that. They could adjust interest rates, buy bonds, sell bonds, and keep the dollar stable. But 3 weeks ago, something broke. The DXY fell through a support level that had held since 2022, and it kept falling. This was not supposed to happen. The Federal Reserve had raised interest rates to the highest level in 20 years. High interest rates usually strengthen a currency. Money flows toward higher yields, but this time the money is flowing out. China is selling U.S. Treasury bonds, not slowly, not quietly, but in record amounts. Russia has already sold most of theirs. Saudi Arabia, the country that once promised to only sell oil for dollars, is now accepting yuan, euros, even gold. The petrodollar system, the foundation of American monetary Part 3, monetary policy failure and currency collapse dominance since 1974, is crumbling in real time. And when the world sells dollars, those dollars come home. They flood back into the American economy, which creates inflation. Not the 2% inflation the Fed talks about, real inflation. The kind that shows up in grocery bills, fuel prices, rent, the kind that destroys savings accounts, the kind that forces people to look for alternatives. And silver, along with gold, is the oldest alternative in human history. Here is where the mathematics becomes inescapable. The money supply has expanded by 40% since 2020. 40% more dollars chasing roughly the same amount of goods. But silver has not risen by 40%. It has barely doubled, which means, in terms of the money supply, silver is undervalued by half. At some point, the price has to catch up. It is not a question of if, it is a question of when. And the charts suggest when is now. There's another ratio that historians watch, the gold to silver ratio. Right now, it takes 75 ounces of silver to buy 1 ounce of gold. But for most of human history, that ratio is 15 to 1. Even in modern markets, the average over the last century is around 50 to 1. So why is it 75 to 1 today? Because silver has been suppressed, treated as an industrial metal, not a monetary asset. But that perception is changing, and when perceptions change, ratios revert. If gold stays at $3,000 per ounce and the ratio reverts to just 20 to 1, silver reaches $150. If the ratio goes back to the historical 15 to 1, silver reaches $200. These are not wild projections. These are mathematical corrections based on centuries of market behavior. The Federal Reserve knows this. They know that if silver explodes, it exposes the failure of their currency management. It tells the world that hard assets are safer than paper promises, and that destroys confidence in the entire system. So they face an impossible choice. If they raise interest rates to defend the dollar, they crash the bond market and the housing market. Banks fail. Pension funds collapse. The government is forced to print money to bail everyone out, which weakens the dollar even more. If they lower interest rates to support the economy, the dollar falls immediately, and everyone runs to gold and silver for protection. Either way, they lose. This is what economists call checkmate. There is no move left that solves the problem. The debt is too large, the deficits are too big, the promises are too many, and the productive capacity of the economy cannot support it all. So the market is making the decision for them. Capital is leaving dollars not just from foreign central banks, but from American citizens. The Google search data shows it clearly. Searches for how to buy silver have spiked 300% in the last month. The public is waking up slowly. Then suddenly they're realizing that the system they trusted, the system that promised their savings would hold value, is failing. And they are moving their wealth into something that cannot be printed, something that has been money for 5,000 years, something that governments cannot create with a keystroke. The institutions are watching this. Pension funds manage trillions of dollars. If just 1% of that capital allocates to silver, it would buy the entire annual supply 10 times over. That is not an exaggeration. The silver market is tiny compared to global capital markets, which means when the big money decides to move, it moves the price violently. The moment silver crosses $100, the psychology shifts. It is no longer a cheap industrial metal, it becomes a monetary asset. And monetary assets attract institutional capital. The dam is cracking, the water is rising, and the people in charge have no sandbags left. There's a meeting that happens every Monday morning in the corner offices of major banks. The risk management team gathers, they review positions, they calculate exposure. And for the past month, every single meeting has ended with the same question. What happens if silver actually goes to 150? Nobody has a good answer because the honest answer is chaos. But chaos for some is opportunity for others, and understanding which side of that divide a person stands on determines everything. Let us start with the most likely scenario, the base case. Silver climbs steadily over the next 2 to 4 weeks, reaching between $120 and $150 per ounce. The banks cover their short positions gradually. There is pain, but it is managed pain. The exchanges raise margin requirements to slow down the speculators. Some retail. Traders get shaken out by volatility, but the physical buyers, the ones who bought metal and put it in a vault, they hold and they profit. This scenario has a 40% probability. It is orderly. It is controlled. It is what the system hopes will happen. But there is a second scenario, the rapid spike. This is where silver gaps up in a matter of days, not weeks. A major short seller fails to meet a margin call. Their position is Part 4, Strategic Implications and Risk Assessment liquidated by the clearinghouse, which means the clearinghouse has to buy back millions of ounces at market price. Immediately, that buying creates a feedback loop. The price jumps. Other short sellers hit their margin limits. More forced buying, higher prices. The COMEX declares force majeure, a legal term meaning an extraordinary circumstance. They suspend delivery obligations. They settle contracts in cash at prices significantly above spot, and the public market goes into frenzy. This scenario has a 35% probability. It is violent. It is profitable for those positioned correctly, and it is devastating for those caught on the wrong side. Then there's the third scenario, the one nobody wants to talk about publicly, the manipulation extension. The banks call in favors. Central banks coordinate intervention. Trading is halted. Margin requirements are raised so high that only institutions can participate. New rules are implemented overnight. The price is forced back down below $100. The short squeeze is delayed, not canceled, just delayed because the fundamentals do not disappear. The supply deficit remains, the industrial demand continues, the currency debasement accelerates. Eventually, the price must reflect reality, but eventually can take months. And in those months, leverage kills traders. This scenario has a 15% probability. It is the risk that keeps physical silver buyers awake at night. The fear that the game is rigged and the riggers will not allow them to win. And finally, there is the black swan, the 10% scenario that changes everything. Multiple exchanges default simultaneously. Major banks collapse from derivative exposure. Governments impose capital controls. Silver trading is suspended indefinitely. Or the opposite extreme. Silver becomes the trigger for a broader financial crisis. The derivatives market worth over $100 trillion unravels. Counterparty failures cascade through the system. And in the chaos, silver becomes unobtainable at any price. This is the scenario where the price becomes irrelevant because the system itself has broken. So what does a rational person do with this information? The corporate treasurer managing company cash reserves should consider a 2 to 5% allocation to physical silver, not as speculation, as insurance. The manufacturer who uses silver in production should lock in forward supply contracts now before the price spikes, before the shortage becomes critical. The investment professional managing client portfolios should understand that silver offers asymmetric risk-reward. The downside is limited. Maybe it falls back to $70. But the upside, if any of the bullish scenarios play out, is multiples of the current price. The entrepreneur, the small business owner, the individual trying to preserve wealth should recognize that silver is one of the few assets still accessible to ordinary people. You cannot buy a meaningful position in commercial real estate. You cannot afford significant gold holdings at $3,000 per ounce, but you can buy silver, and you can hold it outside the banking system. Which brings us to the final point, risk. Because everything discussed in this analysis carries risk. The banks could manipulate the market longer than expected. The government could confiscate precious metals as they did with gold in 1933. They could impose windfall profit taxes on silver gains. They could restrict the movement and sale of bullion. These are not conspiracy theories. These are historical precedents. When governments face currency crisis, they do desperate things. So position size matters. Never invest more than you can afford to lose completely. Never use leverage or margin to buy silver. Never tell everyone you know about your holdings. Privacy in times of monetary chaos is survival. The analysis is complete. The technical pattern has triggered. The fundamentals support a major price movement. The monetary backdrop is deteriorating. The probability favors those holding physical metal. But probability is not certainty. And the only certainty is that the system is under stress. How that stress resolves will define the next decade of global finance. The train is leaving the station. The question is not whether to board. The question is, are you already on it? This is financial advice. This is analysis. This is documentation of a moment in history. What you do with this information is your decision, but the clock is ticking.